Welcome to the deep dive. If you're getting ready for a big meeting, or maybe you're just trying to keep track of the markets, you know the feeling.
Oh, yeah.
You are just drowning in financial data.
Yeah.
It's a flood of reports and metrics and headlines that all seem to contradict each other.
It's overwhelming.
It is. So our mission today is pretty simple. We want to give you the expert shortcut. We're going to do a deep dive into the essential toolkit for financial statement analysis. The goal here is so you can be well-informed, sure, but more than that, you can be diagnostic about a company's performance.
That's exactly right. Diagnostic is the perfect word. The goal isn't just to, report the numbers back.
Right.
It's to understand what they're predicting. When we really boil down why we even bother with financial statements, there are two driving goals.
Okay.
First, we use them to predict a company's future, its profitability, its cash flows, all by studying its past performance.
And the second?
And second, we use them like a diagnostic kit to evaluate current performance. You're looking for existing problem areas before they turn into, crises.
So it's not just a look back. It's like a crystal ball and a doctor's toolkit all in one.
That's a great way to put it. And what's absolutely crucial to remember here is that the usefulness of these tools, especially financial ratios, it's hugely enhanced when you compare them.
You need context.
Context is everything. I mean, looking at a company's ratios against its own past performance, that's helpful, yeah. But they become so much more powerful when you stack them up against competitors in the same industry.
Perfect. Well, let's hand over that toolkit. We're going to start with some foundational ratios, kind of a checklist for any savvy investor.
Good place to start.
Then we'll get into the super intuitive common size statements. And then finally, we'll break down the really powerful DuPont framework. It helps explain why a company is performing the way it is. All right, let's build that foundation. Financial ratios. I think we can assume everyone listening knows the basics. So let's really focus on the implication.
Yes. The magic is in the interpretation, not the calculation.
Exactly. So instead of just a list of definitions, let's talk about maybe the 6 most common ratios and, the questions they actually answer.
Let's do it.
Okay, first question. How much of the business is funded by borrowing? What percentage is owned by creditors?
That's your debt ratio. It's pretty simple. It tells you what percentage of the company's total assets are funded by debt.
And what are we looking for there?
You're watching the trend. If you see that number creeping upward, it signals more risk. Why? Because creditors have a larger claim on the company's assets.
And you have to compare that to the industries.
No, absolutely. I mean, a high debt ratio might be totally normal for a utility company, but it's a huge flashing red light for a tech startup.
Okay, next question. How quickly can a company pay off its immediate short-term bills?
That brings us to liquidity. And for that, we look at the current ratio. It's a really quick snapshot of a company's ability to pay its short-term debts.
I've always heard that 2 to 1 is the ideal number. Is that right?
That's a dangerous oversimplification. It really is. What matters more is the composition of those current assets.
You mean is it cash or something else?
Exactly. Is it cash, which is great? Or is it a warehouse full of slow-moving inventory? A high ratio might even be a bad thing. It could signal inefficiency, too much cash just sitting around doing nothing.
Got it. Okay, let's switch gears from risk to making money, profitability.
The core driver. We can start with return on sales or profit margin. This is just the number of pennies in profit made on each dollar of sales.
And here I imagine industry context is everything.
It's paramount. A 2% return on sales might be fantastic for a grocery chain, a high-volume business.
But terrible for a software company.
A complete disaster. You have to know the baseline you're comparing against.
Okay, so profitability is one thing, but they also have to use their resources well. Let's talk efficiency.
Yes, asset turnover. This one is so important. It tells you the number of sales dollars the company generates from each dollar of assets it holds.
So it's a measure of productivity?
It's pure productivity. Are they generating a lot of revenue without needing to spend a ton on new factories or equipment? If this number is falling, it means management is buying assets faster than they're generating sales from them. That's a problem.
All right, next up is the one that really matters to the owners.
The ultimate metric for them, yeah. The return on equity, or ROE. This shows the pennies in profit generated for each dollar invested by the stockholders. It's the bottom line for them.
But it's just the result, not the whole story.
That's it. Later on, we're going to use that DuPont framework to really dissect how they got that ROE.
Love it. Okay, final one. Let's talk about market expectation. The price-earnings ratio.
The PE ratio, yeah. This is where things get a little abstract, but it's It's arguably the most important metric for valuation.
What's it really telling us?
It's the market's grade on the company's future growth potential. It tells you how many dollars an investor's willing to pay today for $1 of the company's current earnings.
So a high PE means the market expects big things?
Big things. Rapid growth. If it's low, say an 8, the market might be skeptical about the future, or maybe the whole industry is just out of favor.
Okay, so those 6 ratios give us a really solid, quick diagnostic baseline, but they still have a problem, right? They don't really help us compare a massive company with, say, a tiny, fast-growing startup.
Right, the scale issue.
Exactly. So to neutralize for scale, we move to what I think is the fastest and most intuitive tool out there, common-size financial statements.
The CSFS. I love these. It's genius in its simplicity. It's how you compare an elephant to a mouse.
How's it work?
It's so easy. You prepare them by taking every single number on the financial statements, every line item, and dividing it by the total sales for that year.
So everything just becomes a percentage of the sales dollar. If my sales are $1 billion and my cost of goods is $700 million, my common-size KGS is just 70%.
That's it. It normalizes everything. It lets you do a direct apples-to-apples comparison across different years for the same company, or even better, between 2 totally different companies, no matter their size.
Let's talk about the specific insights you get. What does the common-size income statement tell you?
If you think there's a profitability problem, this is your first stop. The common-size income statement shows you instantly how many pennies of each expense you have for each dollar of sales.
So you can spot the leak.
You can spot the exact leak. If your profit margin is dropping, you pull this up, put it next to your main competitors, and you can see, oh, wow, our R&D budget is way higher, or our administrative overhead is killing us. It flags the outliers immediately.
That's incredibly powerful. And what about on the balance sheet side?
Well, the asset section of the common-size balance sheet tells you how many pennies of each asset are needed to generate $1 of sales.
An efficiency check.
An immediate check on your capital intensity. If your competitor only needs, say, 50 cents of inventory to generate $1 of sales, you need 80 cents, you've got a major working capital problem to solve. And, this focus on profitability and efficiency leads us right into our next tool, the DuPont framework. This is really the key to diagnosis. It's more than a ratio. It's a mandatory dissection of why a company's performance is what it is.
Okay, let's unpack this.
The DuPont framework is so powerful because it takes that big metric we mentioned earlier, return on equity, and it breaks it into its 3 core drivers.
Right. Profitability, efficiency, and leverage. It tells you the source of that return.
So let's start with component 1, profitability.
Profitability is calculated as net income divided by sales. That's our return on sales ratio again. If this part of the equation is low, it means the company is just failing to squeeze enough profit out of each dollar it sells.
Pretty straightforward. Then you multiply that by the second driver, efficiency.
And that's our asset turnover ratio, sales divided by total assets. This tells you how well management is using the assets they control to actually generate revenue.
So a company could have thin margins.
Very thin margins, but if they're super efficient, if their asset turnover is really high, that number can compensate. Okay, and those first 2 multiplied together give you return on assets. Then we bring in the third piece, the multiplier, leverage.
Yes, leverage. The assets to equity ratio. This is the multiplier of both risk and reward.
How does that work?
You calculate it as assets divided by equity, and its interpretation is so important. It shows you how many dollars of assets a company is able to buy using each dollar invested by its stockholders.
So a higher number means more debt.
More debt is being used to finance the assets, and that magnifies returns when things are good, but it disastrously magnifies losses when things go bad.
So if we see a company with a fantastic ROE, DuPont immediately tells us if it's because they're super profitable, incredibly efficient, or just taking on a mountain of debt.
Precisely. And this is where all the tools connect. If your DuPont analysis shows the problem is poor profitability, what do?
You go right back to the common-size income statement.
Exactly. It's the best tool for figuring out which specific expenses are out of line.
That connection is just so powerful. Now, let's talk about the trade-off that's built right into this, the margin versus turnover trade-off.
Absolutely. This is crucial. Just think of it as 2 totally different business models that can achieve the same goal. On one hand, you have companies that focus on high margin.
Luxury brands.
Luxury retailers, specialized software companies. They have low asset turnover because their products move slowly, but they make a huge profit on every single sale.
And on the other hand, you've got the volume players.
The Walmarts, the grocery chains of the world, they operate on razor-thin margins, very low profitability per sale. But they can still get a perfectly good return on assets because their turnover is incredibly high. Their assets are always moving.
So DuPont helps you see which strategy they're playing and if it's working.
Immediately. It categorizes them and diagnoses their success all at once.
Okay, so we spent a lot of time on ratios that come from the balance sheet and the income statement, which is, that's traditional. But doing that often means we overlook the one metric that really defines whether a company survives or not: cash. Why are cash flow ratios so often ignored until it's too late?
I think it's because net income can look deceptively healthy, right up until you look under the hood. Cash flow ratios become critical in a few specific scenarios where relying on reported net income can be, well, catastrophic.
Okay,
And here's where it gets really interesting, because this is often where management bias can hide.
so give us the scenarios. When do we need to pull out the cash flow statement immediately?
Okay, first, when net income is getting hit by big non-cash expenses, think massive depreciation charges. The net income number looks bad, but the actual operating cash coming in the door is still strong.
And the second scenario, I think you mentioned this is where rapid growth can actually be a problem.
Yes. This one trips up a lot of analysts. When a company is growing super fast, its cash from operations is often much, much less than its reported net income.
Why is that?
Because high growth just consumes working capital. You're buying more inventory, your accounts receivable are ballooning because new customers are buying on credit. So on paper, you look profitable, but you're actually burning through cash. It can lead to a sudden liquidity crisis.
And the third scenario sounds a bit more cynical: checking for manipulation.
It is. This is when management has a really strong incentive to bias the reported net income. Maybe they need to get a loan, or maybe their annual bonus is tied to hitting an earnings target.
So they play with the accounting assumptions?
They can get very aggressive. But operating cash flow is much, much harder to manipulate. That makes the operating cash flow to net income ratio a vital check. If that ratio is consistently below 1, it is a huge red flag that the quality of those earnings is low.
All right, we've built this amazing diagnostic toolkit. We have the 6 core ratios, the common size statements, the DuPont analysis, the cash flow checks. But I think we have to end this with a huge warning label.
Yes, a very big one.
Financial analysis usually doesn't give you the answers. It just points you to the areas where you need to ask more questions.
That is the single most important caveat. You should never, ever base a final decision just on analyzing these numbers, because the numbers themselves have inherent limitations.
So what are the key cautions we need to remember?
Okay, first, remember that the financial statements don't contain everything. They can't. They lack all the qualitative factors.
Like the strength of the management team.
The strength of management, the brand's reputation, the status of a secret R&D project. You can't capture genius on a balance sheet.
Good point. Second caution.
Comparability is a constant struggle. You can't always properly compare statements between two companies. There are differences in how they classify things. Maybe they're in slightly different industries, or they use different accounting methods. The analyst has to do a lot of work to normalize that data first.
And we shouldn't be looking for a magic bullet.
No. Most of the time, you're not going to find one smoking gun that, if you fix it, solves all the company's problems. Performance issues are usually complex, they're interconnected, they need deep operational changes, not just a fix in a spreadsheet.
And finally, the danger of looking too far backward.
This is a huge pitfall. If you focus too much on historical data, you can easily overlook critical current information. Things like a market shift, a new technology that's disrupting everything, a big regulatory change. Ratio analysis tells you where they have been, not necessarily where they are going.
What a fantastic rundown. I feel like we've given you, the listener, the ability to really diagnose issues, to spot the profitability problem or the efficiency leak, not just summarize results. You have a process now, not just a list.
And that ability to diagnose, that's the whole key. But we do want to leave you with one final thought, building on that last caution about historical data. Since we know analysis can be misleading if the past distracts us from the present, ask yourself this. What relevant current information about a company's market, its competitive landscape, or some impending tech shift must always be layered over this historical analysis to make sure your diagnosis is actually useful? Go find the industry trends first, then apply the math. That's when your analysis becomes truly powerful.